Are you wondering how you can use a partnership or joint venture structure on your next real estate deal? In this video, I'm going to walk you through how partnerships work and how you can use them to build your real estate portfolio. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 12-year real estate veteran, host of a real estate TV show, host of a real estate investing podcast, and the author of the real estate book, Sell for More. So let's get right into it and talk about joint ventures and partnerships. And before we get started, I want to go through the keys of a real estate deal. So there's 4 things that every real estate deal needs. And the first one is the deal itself, or the property. You can't buy real estate without actually having the property. And then you need your equity. So this is your capital, this is your down payment, this is the renovation budget, reserves, the equity coming into the deal. And then you have financing. And then you have operations or management. So I'll say ops and management. So these are the 4 keys that every single real estate deal needs. Now, why do I bring this up when we're talking about partnerships? Well, partnerships and joint ventures, this is a great way to partner with people who are bringing other keys of the real estate deal to the deal. So you might be a person who has, let's say, who finds the deal, but you don't have any equity, you don't have capital to bring into the deal. Or maybe you have the deal and then you have operations experience, but you need help with financing. You can't get a lender to approve you for financing. Well, this is where a partnership really comes into play, because you can bring in other people who have different skills, who have different assets, and together you can enter into a real estate partnership or joint venture and make a profit. So let's talk about how partnerships work. Now I'm going to draw my circle here. So this is the piece of the deal pie. So like I said, you can have different people bringing different strengths into the partnership. Now, I would say a misconception a lot of people have is that a partnership is only 2 people. So I'll start off with that, but then we'll get a little bit more complicated. In a 2-person partnership, the most common division we see in what each party is bringing to the equation is one person will find the deal typically, and they will have the real estate experience, so they'll manage the deal, they'll run it until completion. So that's person A. Now person B, they most often bring the capital, so they're bringing the down payment, the renovation budget, reserves, and then they're also qualifying for financing. And in this case, typically it's going to be a 50-50 split. And you see this a lot in single family homes. You'll have a real estate, the active real estate partner there, and then they're always sourcing capital. This is a 2-person example, but let's say there are 4 partners in a deal. And like we saw here, there are lots of different things a partner can contribute to a real estate investment deal. So let's say partner A finds the deal, then they put the team together. Partner B is bringing the capital required for the deal. Now let's say partner C, let's say the other partners don't have the balance sheet for a lender to feel comfortable lending the money for the project for them. So partner C will come in and they will bring the balance sheet so they can secure financing for the project. And partner D may have construction management experience, and maybe this is a heavy lift. So there's lots of property work that has to go done, lots of contractors, all that sort of stuff. And partner D is bringing that to the equation. This type of structure, whether it's a 2-person partnership, 3-person, 4-person partnership, it works well with single family homes. You see that most often. But I've also had people enter into partnership agreements rather than syndicating or starting a fund to doing larger multifamily real estate deals. And of course, this is a multifamily real estate channel. And on my podcast, Purchase to Profits, I've had a couple people, instead of raising money through a syndication, they enter into a partnership. There is one thing though that we really have to keep in mind at all times when we're talking about partnerships in the structure, whether it's a 2-person, 3-person, 4-person partnership, it doesn't matter. Whether or not a person is only bringing capital, whether or not they are qualifying for financing, whether or not they're just managing the deal as a partner, or whether or not they're finding the deal and then having other partners come in. Each and every partner involved in the deal is considered to be active. There is no passive investing in a partnership structure. So that means that if this project goes belly up, if things hit the fan and everything goes south, each and every partner involved in the deal is responsible. So that means a lender can go after all 4 partners. Whereas in a syndication or a fund structure, we have something called a limited partner and a general partner. And I'll put a link up to those videos right here. And that really affords a lot of protection to the passive investors. That's true passive investing. But in a partnership structure, keep in mind that every single partner in the deal, there is no passive investing. So even though this partner might just be bringing the money, they're active. So they're taking on a whole lot more risk rather than investing through a limited partnership in a syndication or a fund structure. Now, where do we see partnerships pop up most often? Well, the 50-50 with 2 partnerships, that's most common in single family homes and residential real estate. You often have a real estate investor, a more active person who's looking for other people's money to use to build a portfolio. And then you have a person bringing the capital and oftentimes the financing who doesn't have the real estate experience. One can't happen without the other, so it's a great partnership. The active real estate partner can grow their portfolio and then earn a return for the investor. The investor doesn't have the real estate experience, but now they're able to get involved in a real estate project and earn the return and some benefits that go along with real estate. But also we have partnerships happen in larger properties. I've had guests on my podcast, Purchase to Profits, where they've done a 200 unit deal in a partnership. There were 4 of them. They each brought something different to the project, just like what I showed in my 4-person example here. One person had more capital, one person had more management experience, and the split doesn't have to be even. It doesn't have to be 25, 25, 25, or 25. If you have 4 people in there, it can be 60-40. It can be 70-30. It all depends on the value assigned in the partnership by what the person's bringing. So let's say somebody is very, very experienced and they're doing almost everything in the deal, and the other person is giving a minor role, a minor contribution. Well, obviously their share of the partnership will be a whole lot less. But don't get stuck thinking that a partnership is only for a single family home or a duplex, because there are people acquiring multifamily properties in a partnership structure. It's just not as common because, like I said, there's no passive investing. So there are no protections afforded under the law for somebody just bringing their capital. So definitely keep that in mind. So I really hope this was helpful in explaining what partnerships can bring and how they're structured. And if you have any questions about the deals I'm doing and you want to learn more, head on over to callseth.com and set up a quick 20-minute phone call with me. And if you like this video, if you found this helpful, hit the like button, leave a comment, let me know what you think. And until next time, happy investing.